What if I told you there's a federal tax credit worth over $10,000 that a significant number of Canadian seniors qualify for, and most of them have never applied for it? Not because the process is impossibly complicated, not because their doctor told them they didn't qualify, simply because nobody ever mentioned it existed. Today, we're talking about the disability tax credit, the DTC, and specifically why so many Canadian retirees with chronic health conditions are leaving real money on the table every single year. In 2026, the federal disability amount sits at over $10,000. When you combine the federal credit with provincial top-ups, many seniors are looking at annual tax savings of $2,000 or more. And here's the part that catches most people off guard. If you qualified in previous years but never claimed it, you may be able to go back up to 10 years and collect every dollar you missed. We're going to cover who actually qualifies, and I think some of you will be surprised how the application works, what happens if you don't owe enough tax to use the credit yourself, and a connected savings program that most people have never heard of that can add thousands more on top of the credit. I'll also walk through a realistic example later that shows exactly how the numbers add up, because I want you to leave this video with a clear picture of what this could mean for your own situation. Keep watching, because the part about going back 10 years is something a lot of people miss entirely, and it may be the most valuable thing in this video. Let's start with the biggest misconception, and it's a common one. A lot of seniors hear the words disability tax credit and immediately think it applies to someone else, someone in a wheelchair, someone who is completely unable to function independently. And that assumption causes them to stop reading, stop listening, and walk away from money they may genuinely be owed. The Canada Revenue Agency doesn't evaluate this credit based on your diagnosis. It evaluates it based on the daily impact of your condition. The question the CRA is actually asking is this: does your condition markedly limit your ability to carry out basic activities of daily life? Things like walking, dressing, feeding yourself, seeing, hearing, or managing your medications and personal care. That means conditions like severe arthritis that makes it genuinely difficult to dress or move around independently, that can qualify. Type 1 diabetes requires life-sustaining therapy by its very nature, and CRA recognizes that. Type 2 diabetes with intensive management can qualify as well, if the daily effort required to manage it reaches a certain threshold each week. Significant vision loss, serious hearing impairment, advanced Parkinson's, the lasting effects of a stroke, severe lung or heart disease that sharply limits physical function, all of these are recognized. Think about someone like Eleanor. She's 72, lives alone in Winnipeg, and was diagnosed with rheumatoid arthritis more than a decade ago. Her condition has progressed to the point where getting dressed in the morning takes her much longer than it used to, and she struggles with it on most days. She's been managing it, filing her taxes every year, seeing her doctor regularly, but nobody ever suggested she might qualify for the disability tax credit. That's an incredibly common story. The credit exists for people exactly like Eleanor, and the first step is simply asking the question. Now, here's something worth sitting with for a moment. The impact of this credit is not trivial. Federally, the disability amount in 2026 is over $10,000. At the federal tax rate, that translates to roughly $1,500 per year directly off your tax bill. But the federal credit is only part of the picture. Every province adds its own disability amount on top of that. In Ontario, combined federal and provincial savings can reach about $2,000 annually. In Manitoba, where the provincial disability amount is substantially higher, the combined savings can exceed $3,000 per year. Over time, those numbers become significant, and that's before we even get to the retroactive piece, which I want to spend some real time on, because for many seniors watching this right now, it could represent the largest single financial recovery they've seen in years. Before I get there, I want to pause for just a moment, because what I'm about to explain is something that genuinely surprises people, and I want to make sure you're following along closely. If you're finding this information useful and want to keep getting clear, practical retirement updates covering things like CPP, OAS, GIS, CRA changes, and programs like this one, consider subscribing to Canadian Retirement Benefits. We focus specifically on content that's relevant and actionable for Canadian seniors. Now, the retroactive claim. If you had a qualifying condition in prior years and never applied for the disability tax credit, the CRA allows you to go back and adjust your past tax returns for up to 10 years. That means if your condition has been present and limiting since 2016 and you apply and get approved today, you can file adjustment requests for every missed year going back to 2016. The federal disability amounts for each of those years are on the public record. They've grown gradually over the decade. Add them up across all 10 years, apply the 15% federal rate, and you're looking at a federal refund alone that can exceed $13,000. Add the provincial credits for each of those years, and depending on your province, that could mean several thousand more on top. In total, some seniors are recovering $17,000 or more from a single approved application. Let me walk you through how this looks in practice. Take a retired teacher in Ontario, and let's call him Frank. Frank is 68 and has had type 1 diabetes his entire adult life. He's been on insulin for decades, monitors his blood glucose multiple times a day, and manages a fairly intensive daily health routine. His doctor confirmed that he has required this level of therapy for many years. Frank had never applied for the DTC because he assumed it was for people with more visible physical limitations. When Frank's daughter helped him look into it, they discovered he could potentially claim the credit going back 10 years. Between the federal and Ontario provincial amounts, his estimated total recovery was somewhere in the range of $18,000 to $20,000. That's not a small number. That's a significant portion of a year's income for many retirees. The process started with one form, CRA's T2201, the Disability Tax Credit Certificate. It needs to be completed and signed by a qualified medical practitioner. For most conditions, that means a family doctor or nurse practitioner. For vision-related impairments, an optometrist can certify. For hearing, an audiologist. For mobility and self-care limitations, a physiotherapist or occupational therapist can sign off on those specific sections. The most important thing about the form, and this is where many applications run into trouble, is the language used to describe the limitation. The CRA looks for very specific phrasing. The certifying practitioner needs to describe the person as markedly restricted in a daily activity, and that restriction needs to be present all or substantially all of the time. The practical standard is at least 90% of the time, and the condition must have lasted or be expected to last at least 12 months. If your doctor writes a general note that your arthritis is painful or your diabetes is difficult to manage, that may not be sufficient. The form needs to clearly connect the condition to a specific functional limitation, using the kind of language the CRA is trained to look for. This is one reason it can be worth getting some guidance when completing the application, either from a knowledgeable accountant, a patient advocate, or a doctor who has completed these forms before. A well-prepared application gets approved. A vague or incomplete one can be denied even when the person genuinely qualifies. Now, there's one more piece of this that most people don't know about, and it's connected to the DTC in a way that makes qualifying for the credit even more valuable. Once your disability tax credit is approved, you become eligible to open a registered disability savings plan, an RDSP. This is a federal savings program with some of the most generous government matching available anywhere in the Canadian tax system. For lower income individuals, the federal government will match personal contributions at a rate of up to 300% on the first portion of what you deposit. There's also a government bond component that adds money to the account each year, even without any personal contribution for those with limited income. The lifetime matching available through this program is substantial. The government grants alone can reach up to $70,000 over time. Even for seniors who start the program later in life, there are provisions to carry forward unused entitlements from prior years, meaning getting in late doesn't mean you've necessarily missed everything. For someone on a fixed income who qualifies for both the DTC and the RDSP, the combined value of the tax credit, the retroactive refunds, and the savings plan grants can add up to a genuinely life-changing amount. There's one more thing I want to cover before we close because it affects a lot of households where the senior applying for the credit may not have a large tax bill of their own. The disability tax credit is non-refundable. which means it reduces the taxes you owe, but if you don't owe much in the first place, some or all of the credit could go unused. The good news is that the unused portion is transferable. A senior who doesn't have enough tax owing to fully benefit from the credit can transfer the remaining amount to a supporting family member. That could be a spouse or common law partner, an adult child, a parent, a sibling, a grandparent. The rules are fairly broad. So even if the senior's own tax liability is minimal, the household can still capture the full value of the credit through the family member who does have a tax balance. This transferability piece means that in many families, the right conversation isn't just does mom qualify for the DTC, it's also who in our household would benefit most from receiving that credit and making sure the form is completed with that in mind. Let's bring this all together. The disability tax credit is not a niche benefit for a narrow group of people. It applies to a wide range of chronic conditions that are common among Canadian seniors: arthritis, diabetes, vision loss, hearing loss, heart and lung disease, neurological conditions, and more. The test is always about daily impact, not diagnosis labels. And with federal and provincial amounts combined, the annual tax savings for an approved applicant can easily reach $2,000 or more. If you have a condition that's been limiting your daily function for more than a year, it costs nothing to find out if you qualify. Talk to your doctor. Ask specifically about the T2201 form and whether your condition meets the markedly restricted standard. If you've been managing a qualifying condition for several years and never claimed the credit, bring up the possibility of a retroactive claim. Up to 10 years of missed credits is a meaningful amount of money, and the adjustment process, while it takes some paperwork, is straightforward once the application is approved. And if you qualify, look into the RDSP. The government matching available through that program is unlike anything else in the Canadian retirement savings landscape, and it's available specifically to people who hold an approved DTC. You've worked hard for your retirement. Programs like this one exist to help protect what you've built. The only thing standing between most eligible seniors and this credit is awareness. And now you have it. If you'd like to stay informed about CRA updates, senior benefits, CPP, OAS, GIS, and retirement planning topics like this one, consider subscribing to Canadian Retirement Benefits. Thank you for watching, and take care.